Hello, everyone. Welcome to the Microstructure Exchange. So today we have Mehmet Sağlam, who's going to talk about Robinhood trading and the impact of that. And before we begin, we have an announcement. We at Stockholm University will host the summer school in market microstructure this summer that is taught by Albert Menkveld and Thierry Foucault. So if you're a PhD student or if you have a PhD student, you should check that out. That will be early July in Stockholm. So for the talk today, Mehmet has prepared a couple of slides designated for taking questions. So we will wait until then with the voice questions, but anytime during the seminar, you can type in the chat your questions or wait for the slides, the designated slides to raise your hand. And Mehmet's co-author, Preston, is here, so he can also answer questions on the fly in the chat. I think that is all that we have to announce. So Mehmet, the screen is yours.
Thanks, Björn. Thanks for the quick introduction. So this is a joint work with Preston. As Björn mentioned, probably I won't be able to go through the chat messages, but I'm sure Preston will be happy to help any urgent questions until the question break. So, you know, this room is probably familiar with the retail landscape in the US, but let me give you a couple of slides to set the stage. So clearly, you know, over the last decade or so, retail traders have become an increasing element of the markets. So this is partly thanks to Robinhood, right? So they are founded in 2013, and they came to this space to democratize investing. And then, you know, it took some time for them to gain traction, right? So it was not a big threat to the existing players up until 2019, right? So in 2019, they became kind of a threat to these existing players, right? Charles Schwab, TD, E-Trade, they have all started to go commission-free as well, right? And then we had the unfortunate, the COVID crisis, right? Again, we got stuck at home. Some traders got stimulus checks, right, from the government that they don't know what to do with, right? So they started to invest on these platforms, primarily on Robinhood as well. And then, you know, in 2021, I think we have observed a very unprecedented event, right? So this is the GameStop episode where, you know, maybe 50% of all trading was due to retail traders. So, you know, in this space, clearly, Robinhood is the #1 player, right? So they have more than 20 million funded retail accounts. This is partly due to their, you know, easy to use mobile app, right? So it is very user friendly. And, you know, I think retail traders have easy time to submit their orders in the space. So let me walk you through one of these default options. And once I go through this, share-based market order UI, we will be also be able to, define what order coloring is. So it's pretty easy, easy to use app. You only need 4 steps to submit a market order. So in this case, you have to pick the ticker, right? So in this case, we chose Apple. And then you have to decide to buy or sell, right? So let's pick buy. And then on the third screen, you have to specify number of shares, right? So in this case, we pick just 1. And then on the final screen, you just swipe up, and then you are done with your order submission, right? So this is pretty easy, fast, and very hassle-free. But let me walk you through some, maybe behind the screen, what is going on, right? So if you zoom in on the third screen first, right? So as an unsophisticated investor, you probably think that you will get executed around these quoted price, right? It also gives an estimated cost, right? So you think that you'll get $173.72 for your order, right? But if you actually read the small font sized, right, fine print, you will see that this is not the case, right? So there's some discrepancy. It says that now your order will execute at $182.4 per share or better. And this is actually a limit price, right? It's set by Robinhood at a 5% above the last traded price. Right? So this is the price that you will observe on the first, on the first screen, right? So this is the market price. What they do is that they just take this price. So typically this is the price that you observe on a NASDAQ exchange. And then you just multiply this by 1.05, right? So you get some maybe sub pennies, and you just floor it to the nearest cent, right? So at the end, 182.4 would be what you are getting, right? As described on this order summary. But, thinking about the client base of Robinhood, right? And thinking about any time that, even after market close, you can just swipe up and send these orders to the marketplace, right? That could be a big, cost to the retail traders, right? So this is what we are going to study in this paper. There is a standard limit order, user interface as well. So in that case, you're not going to be colored, but you can imagine that Robinhood is not incentivizing it, right? So in this case, there are actually 9 screens to accomplish this traditional limit order. And in this case, there is much more user input as well, right? First of all, you have to specify limit order price as well, right? So in this case, this is 125% more screens. So given this, plain choice of user interface, you can argue that Robinhood is discouraging you to use this limit orders UI, but encouraging you to use what I have shown you with the 4 screen, right? Very easy to use platform. So what could be some motivations for order coloring, right? So we have come up with 3 potential explanations, and one of them, and one maybe half of them, is also given by Robinhood. So the first one is investor protection, right? This is what Robinhood states on its website. So they state that they are trying to protect you from potential price volatility. Right? So here the idea is that maybe their servers are not co-located, right? So by the time your order reaches to the marketplace, the ask might have moved. So it's a bit question mark that it would be moving by 5%, but this is what they say, right? So in this case, they are protecting you to, not trading at unfavorable prices. And then they also say that coloring helps cushion against significant price movement and can prevent overspending, right? So that takes us to our second explanation, right? So Robinhood is trying to protect itself, right? So here, the market move against you, right? So if you think about the first example, you might have exactly the same amount, right? $173.72 in your account. That's just one share of this market price. Then, the market move up by 2 cents. Who is going to pay that 2 cents, right? In that case, Robinhood can cancel your order, right? Again, they don't want to do that probably, right? Because they also want to make sure that they get enough trading in their platform as well. So in this case, if you are not going to have this 1.05 above the initial stock price in your account, you're going to get this screen where it says not enough buying power, right? So you're not going to be able to place this order. So I think that takes us to the third motive, right? So Robinhood wants to increase the number of trades, right, on its platform. One way to do this would be, if you think that retail traders could also trade after hours, right? After hours, the spreads are wider. Without this maybe 5% spread over the last trading price, you may not get enough trading, right? So they want to make sure that this trade is done and then they would also be getting their maybe payment for order flow from the market makers. And this is consistent with this view. But if you look at the payment for order flow for Robinhood, compare it to the other competitors, the best one is, in this case, this is just 1 quarter, of course, so I'm not making a big claim about this, but it's 50% higher than even the second best, right? So their order flow becomes much more valuable if some of the retail traders ends up using this highly impatient way of trading, right? And then another reasoning could be fractional revenue. And I think a couple months ago, Maureen presented her paper on fractional trading, and they mentioned that some brokers like Robinhood, they trade on a principal basis with the fractional trades, right? So in this case, I am trying to trade with 5% above the spread, for over the last trading price. Robinhood would be happy to take the counter side, right, for that fractional trade as well. So you can see that, right, Robinhood is on this market as well, right, for fractional trading. And we also see that this is the consistent behavior, right, for Robinhood when you look at what they did with their after-hours trading features. Right, on March 29, 22, they actually extended, right, their trading hours by from 6 p.m. to 8 p.m. after hours, and also in the early trading periods. And now they're also introducing 24 hours trading, right? So here the idea would be you're going to have these order colored trades, and during these illiquid markets, right? So this is especially the case for the just right after the market close, right? So you can have some additional revenue this way as well, right? So if you think about the fractional revenue role that you can get by trading against these impatient traders. Okay. So our main research question is, clearly, is this detrimental to the retail traders, right? And we are specifically interested in one channel, right? So here, this policy is public information, right? So everybody knows about it, right? This 5% order coloring. We would expect some market makers, especially after hours, or especially for stocks with high spreads, they will enter, or they can maybe predict the stocks that they are trading, right? They might just widen their quotes in anticipation of the arrival of these impatient orders from the Robinhood guys, right? And then, next to this, think about, having this in a sequence, right? You can have 5% spread over the last NASDAQ. There could be, since this is going to be printed, that could impact the next NASDAQ trade as well, right? Another dark trade would be benchmarked to that, right? So this is going to be, that's our conjecture, right? Could be a big source of extreme volatility, right? So here I'm not thinking about continuous volatility, right? That's the calculus sense. I'm thinking about jump volatility. So here we are going to think about, is there any increase in the jump volatility of the stock price as well? So what are we gonna, how are we gonna evaluate these questions? We have 2 identification strategies. Right, so the first one is, right, so Robinhood stops, as I mentioned, after hours trading at 6 p.m. before March 29, 22. Right, so we will be able to compare what is going on right before 6 p.m. and around this 5% threshold, and also what happens after that 6 p.m., right, around that threshold as well. And then we will be also able to use the extension as another, quasi-experiment. Right after March 29, Robinhood extends its after-hours trading to 8 p.m., right? So we will be able to take advantage of that as well. So what are our maybe overview of findings? Indeed, we find that there's some economically significant increase in the spreads that the retail traders are paying for these trades. And it is not minuscule. And then we will also have some, preliminary findings regarding this order anticipation channel, right? We will use this sample order book data that was provided by the Verts. So they're only a couple of days, but we will be able to see what are the orders are clustering around. And we will see that there is some big clustering around 5% in anticipation of these retail orders coming to the marketplace. So now that I think I explained the main setup, maybe this is a good time to take any questions, if there is any.
So if there is any question, I think you can just speak up, as there are no hands up at the moment.
So I have a question. Is this mostly around after hours, or the most of the? I mean, 5% is too much for during market hours, right? When you have best execution obligations.
Yeah, we will. We'll see that the market buy orders during intraday trading period as well will be colored. So during market orders, market trading hours as well, you will see coloring. But then all order types will be colored at the end of the market close. Yeah, I will explain what types of orders are colored as well.
Okay.
Should I check the chat as well, Björn, or I'm not?
We had one question there, but Preston covered that, so I think you can move on, Mehmet.
Okay, sounds good. So we have three important areas of related literature. So I'm gonna walk through all of these cases. So the first one is about my own paper. So sorry for the shameless plug here. So in this case, I have a paper with Yasin, right? So we model the high frequency market making behavior. And there are two types of traders in this model, right? Patient versus impatient traders. And in this case, if the high frequency market maker has some order anticipation ability, right, with regards to signals, they're going to quote worse prices, right, for the impatient traders. This is actually very similar to the setup that we have here, right? So Robinhood, with this order coloring policy, they are synthetically creating very impatient traders, right? So you can see that high frequency market makers can anticipate it and would be trying to widen their quotes if they can predict the arrival time of these impatient traders. The second one, I think, is related to the overall order anticipation literature, right? So we have Clark Joseph and Hirschi, right? So they look at empirical data and they observe that HFTs can increase trading costs of non-HFTs, again, using some order anticipation skill. I have another paper on the institutional side, right? So if the institutional broker, if it leaves some footprints in designing their algorithms, right, it could be picked up by strategic traders, and that could lead to higher trading costs as well. And then I think the most related area is the impact of retail trading on market quality, right? So here, Eaton et al., right? So they look at Robinhood outages, right? So when there's an outage, Robinhood trader cannot participate in the market. And surprisingly, they find that at those times, the spreads are lower, right? The volatility is also lower, right? So they tie this to the herding behavior, right? So they find that they are more like momentum traders. And since they are trading in herding, right, they would be, they're going to scare the market makers, and market makers would quote, wider spreads. I think in our paper, we are proposing maybe another channel on top of this one, right? Because of Robinhood's order coloring policy, they are mechanically creating high spread trades, right? So if market makers can anticipate it, right? So they're this is gonna lead to wider spreads that we are observing in the marketplace. So let me jump to some empirical design and some initial results about this, identification strategies. The first one is I just want to give you a couple of tables and pictures to show you, what is going on, what do we see, in the trade data. So this is an example from AMC, right? During a certain day, right? So 22 February 14, right? The close price of AMC is 17.75. We see dark trades, right? For some reason, right? They're always much higher than the adjacent exchange trades, right? So the shaded ones are exchange trades, and then the white rows are dark trades. So here, P stands for New York Stock Exchange, T stands for NASDAQ Exchange, right? So if you think about the coloring policy, right? So let's just zoom in. So in this case, if you just take the NASDAQ price here, 1790, multiply that by 1.05, and round it down to the nearest cent, you see that the dark trades are pretty close to that value, right? So again, this is just a maybe a quick example of what is going on the trade data as well. As there was a question about this, so let me go through in detail. So before March 29, 22, right? So the market hours of Robinhood was a bit limited. So this is the first row. So there are 4 order types that you can use on Robinhood. There is share-based market buys that I just showed in my initial demonstration, and there's share-based market sells. So between the two, only share-based market buys are colored during market hours. So between 9:30 and 4 p.m., only share-based market buys are colored. So this is consistent with their explanation about overspending, right? When you are selling stuff that you own, right, you're not going to be subject to risk of overdrafting. And then there is this dollar-based market buys and dollar-based market sells, right? So in this case, this goes to maybe the fractional aspect of trading, right? So you just specify the dollar amount to trade. There will be some fractional amount. Those are only colored before market hours and also after hours. Okay, so during market hours, only share-based market buys are colored, and the rest is not colored. And in all other times, all order types are colored, right? So as you can see, that's maybe the most unfavorable time for retail traders to color these order types because the spreads are much wider, right? So maybe the implication would be even higher for these times. So for that reason, we are going to focus on mostly after hours trading, but then I will also utilize this discrepancy between buys versus sells as well, right? So the buys are not colored. So buys are colored, sells are not colored. We will see a couple of results regarding that as well. And then after March 29, 22, we observe that everything stays the same in terms of coloring policy, but now there is more trading between 7 a.m. to 9:30 a.m., right? Pre-market. And then there is more trading, additional 2 hours after 6 p.m. after March 29, 22. Okay, so we are going to make use of these extensions as a further identification. Let me give you a picture about how these extreme trades look like, right? So this is from April 2019. So this is before COVID. This is when the market was not that retail heavy, right? So all of a sudden, there's some interesting patterns to digest here, right? So I'm only zooming in, right? So here, this is the y-axis, the change from last trade on NASDAQ, and I'm only using dark exchange trades on the tech, and then I'm zooming in between 4.9% to 5.01%. Okay, so before, since this is before March 29, 22, Robinhood is only open right before 6 p.m. And after 6 p.m., Robinhood is closed. And as you can see, there is a big clustering of exactly 5% trades that happen when Robinhood is open, right? So if you look at, after Robinhood is closed, there's not much trading at all, right? So if you look at maybe just the neighborhood, right? Remember, the coloring policy was a flooring policy, right? So you were rounding it down. And you can see that nothing shows up right above this region, right? And then you can also compare, right? Looks like after 501, there are similar number of trades going on, right? Above 5% level, but all of them are clustered around this region. So you can see that some unsophisticated market, Robinhood retail users, right? They just swipe up. They don't know the policy, and this is anticipated by the market makers or other strategic traders, and they end up trading at exactly 5% above the last transaction price on NASDAQ. So now let's extend our sample. So I want to focus on this identification strategy around March 29 cutoff. So on the left-hand side, I have all stocks, right? All dark exchange trades. And now I don't zoom in, right? In the previous one, I was zooming it here, right? So 4.925. So now I include all trades that are having a spread between 2% and 7%. And here again, we observe similar patterns, right? So first of all, Robinhood is open before 18 on the left panel. Robinhood is closed on the right panel. And look at this big clustering going on at exactly 5% and right below it, right? So there is almost no empty spots here, right? And if you look at the right-hand side when Robinhood is closed, it's almost impossible to see exact 5-point prints, right? So, these market makers are quite strategic about here. And then if you think about this, this continuity around 5%, right? So here, you can argue that right above 5% and right below 5%, they have almost the same density, right? So this could serve as like a control variable. But here, you can see that right below 5%, it's like the treated region. Right above 5% is like the untreated region. And you observe big differences around here. Okay. So here, the density is much lower, right below 5%. Okay. And then now let's look at what happens right after the extension. All of a sudden, you see a big clustering, start seeing a big clustering at 5%. So I think it is worth to note that looks like trading drops, right? At least it's, these extreme trades tend to decay after 6 p.m., right? So typically, maybe many brokers are being closed, or, if you think about institutional traders, right? They leave their job, maybe they are not trading anymore, right? After 6 p.m., there is a bit of decay in trading activity. So you observe that as well here. But now, look at this big density compared to empty spots here, right? So you can see that as soon as Robinhood extended its, trading hours to 8 p.m., many retail traders, they started to trade by swiping up and getting, exposed to this 5% coloring. And then you observe that, there is a much smaller drop in density in the colored region, right, on this graph compared to this one, right? If you look at the drop here versus the drop here, right, the drop here is much smaller. Again, right, so big clustering around 5% before and after this time, right? So here, there was almost no exact 5% prints. So, I think this gets even striking if you just focus on a single stock on a single day. Okay, so this is an example from GME, right, on these meme stock periods. In that case, right, so this is not just a phenomenon around 5%. Okay, so here there is almost no trades that are above 5%. But remember, there will be some competition, right, between market makers, right? This is just the upper limit. But again, we observe the same phenomenon, right? So this actually increases, right? Our, we are gonna do this diff and diff regressions, right? The impact would be even larger because we're not considering what's going on right below these 5% levels as well, right? So here, before 6 p.m., there is much higher extreme spreads, right? But as soon as Robinhood gets closed, there is no, spread event that is even higher than 1%, right? So you can see that this is much more detrimental if you just focus on maybe even for liquid stocks, right? So even for liquid stocks, this has a detrimental effect on retail traders. So we are not considering, Teslas or Apples of the world, but you can see that the same reasoning, they should be impacted by this as well. So now, we do the diff and diff regression. So here we just use use 30 minutes before and after, right? So there is we do a post variable if a trade occurs after 6 p.m. And then we have the treated region where the spread is between, just looking at this continuity around 5%. And we do indeed get significant results for treat and post, right? So for treat and post, this is the region here. You do see lower trade activity in that region, right? Compared to, if you take this decay in trading activity into account, right? So this is still significant effect. We can also use this for the extension, right? So for this one, I'm going to use even a larger, I'm not going to use discontinuity because now, the pre-period would be serving as a control, right? So in this case, I have after 6 p.m. period for March and April. And then I have the post-extension period, which is impacting both of these regions. And then I'm going to show you that high spread trades are much higher after the extension, right? So here you can see that there are much more high spread trades after 6 p.m. post extension. Okay. Maybe this is again a good time to take questions.
Okay, so we had quite a few questions in the chat, and Preston has been working on them. But Mark, do you want to ask your question in voice again?
Yes, thank you. It's really about framing. In some sense, in my mind, let's take the extreme case where the retail traders would have submitted aggressive market orders, but by putting a limit, we're sort of forcing them to be a little more patient, vis-a-vis the sense of their strategy being more patient. But what we're really doing is by setting it at 5%, we create a coordinating equilibrium point for those who might be submitting strategies to take advantage of them. So I don't think it's that we're forcing them into aggressive strategies, which we then take advantage of. I think it's simply facilitating taking advantage of them. And you don't need any language about creating impatience, which I think misses the point and is easily disputed. Thank you.
Yep, thanks.
I was wondering if you have a sense of what proportion of the Robinhood orders are collared?
Yeah, that we don't know, but on any given day, we have around 1,200 high spread trades. So that is between 1% to 5%. So between 4 p.m. and 8 p.m., there are like maybe 3 trades per stock, which are at this extreme spread level.
And we do know that during after hours, all Robinhood default trade types are collared. So anything that does that 4-screen trade, any trade that makes that 4-screen trade is going to have a collared order in after hours. But if you were to say go through and set your own limit order, which would have been that 9-screen trade, you would not be collared. So
Okay, thank you.
As further evidence, I might suggest some cross-sectional analysis vis-a-vis the underlying volatility of the stock. So the 5% won't mean much in the case of stocks that aren't very volatile, but would mean a lot otherwise. It's almost surprising that Robinhood doesn't have a volatility dependent or conditional limit, but at the least you may get more power in what you're suggesting by exploiting that.
Yep, that's a good solution.
Andre.
Speaking of the cross section, is it possible that some of these stocks that Robinhood traders trade after hours have no liquidity whatsoever, so no posted prices? So what we're seeing there, the 5% threshold, is their marketable limits becoming posted limits and executing as such.
So I think in that case, you can take a look at this one, right, for the liquid stuff, right, for the GME, right? So here it's a very liquid stock, right? So there's actually nothing above 5% for this example, right? So again, you can see the impact of this anticipation, right? Given that the spread is very high, even though there is some competition, and given the fact that order protection rule is not active after hours, right? So you can still get these very high spread trades.
PK.
I have a question related to that. So is the policy implication then to make the order protection rule valid throughout the 24 hours, or is it that the Robinhood should present the limit order screen first and encourage people not to submit market orders? I just want to get a sense of what you think is the right thing.
Yeah, I think you touched on all of them. So I think all of them should be on the table. So all of them would be helping with regards to eliminating these type of high spread trades for retail. Currently, we don't have any of them, right? So I think any enforcement on that angle would be improvement to the current policy.
Yeah, I think the business hours, I mean, they were from back in the days, but now computers trade 24 hours. So I think the regulation is slightly lagging behind by cutting it off at the business trading hours, I guess.
Yeah, so I will mention this. So, there is a FINRA, extended disclosure statement, which says that, warning all traders, right? After hours, there is no order protection rules, right? So your trade price could be worse than another extended trading system price. So there is at least some disclosure statement, but of course for retail traders, I don't think that would be enough, right?
So we have another question from Andre.
Just a very quick one. I'm just thinking, if I'm let's say a market maker trying to game this system, and I'm setting these wide spreads, hoping that I'll catch some Robinhood traders, I am missing out on many other traders potentially, right? So the concentration of Robinhood traders must be really, really high during these after-hour periods. And is there any statistics? Are there any statistics that would confirm that they dominate the after hours?
Yeah, I'm not aware of any statistics, but think about they know all the existing order books coming from all exchanges, right? So they know what the best prices are, right? So they can set the best execution price considering all these available quotes, right? So it doesn't have to be always at the 5% level, right? As we have seen with the GME example, you can miss out stuff if you were to just blindly, put 5% at the 5%. But I will show you one evidence that there's at least some clustering of those orders exactly at 5% by strategic traders. So whether these are market makers or other types of traders, that I don't know. But I will give you an example using this NYSE order book sample. There is actually a big clustering around 5% level.
You could also think of the relative mix of informed and uninformed trading will break at 5% if the Robinhood traders are over clustering within it. Then just past that, I'm more likely to be adverse selected. So that it becomes a way to cluster more trades, whatever your aggressiveness is, but not beyond the 5%, where the nature of the market may dramatically change as far as who you're trading against.
Mm-hmm.
Okay, great. Lots of questions. I suggest that we move on. Now another hand is up, but let's move on and take the remaining questions after the conclusion.
Yeah, so let me just show you briefly that you can also set up a similar diff and diff just using the post period, right? So here you can just look at maybe after 6 p.m. periods, anything happening, after 6:20 could be the control, right? So here I have the treatment region, right? So in this case, anything below 5% level would be treated, and we do get similar results if we just focus on after 6 p.m. cutoff as well, right? So here we are using the before extension as a control, and then there's the extension of the after hours trading, and after the extension, we do see that there's more extreme trades happening in the treated region. And now, as I mentioned, I will try to utilize this intraday coloring as well, right? So remember, share-based market buys, they are colored, and share-based market sales are not colored, right? So here, you should see at least, if you look at the intraday order data, right? So strategic traders would be selling to these buys, right? So you should, at least that's our conjecture, there would be more clustering around 5% for sell orders, right? Compared to buy orders coming from external participants. Okay, so for that, so this is the market sales are not colored. So I'm gonna maybe just give you a simple example using single stock, right? So this data is limited in the sense that we only have October 4 and October 5 on the NYSE order book sample, right? So what I can do is I can take all the orders on this specific stock, right? So Space is a pretty retail heavy stock, right? So look at the buy orders versus sell orders. So buy orders are coming from strategic traders. And if you look at that, their clustering is not at all at 5%. But if you look at the sell orders, there's a big, big histogram that's exactly occurs at 5%. And then, I can extend this to all stocks, right? So one, problem with this policy is that it's not just impacting common stocks, right? It's actually impacting all exchange traded products, right? ETFs included, right? You can imagine that this would be much more costlier for this extended universe of securities. So here I take all securities, I look at all strategic, traders buy orders versus their sell orders. Again, you observe that sell orders have clustering around 5%, right? But you don't see that clustering for the buy orders, right? Again, this is a limited evidence, of course, right? This order book data is just, I think, having a trial version, but we are planning to extend this analysis once we have, maybe once this is extended to multiple years and days. Let me also think about some, economic significance here, right? So here, again, we can only do some back of the envelope calculation, right? So we won't be able to capture all of the impact of this policy, right? As you mentioned, right? So some stocks like Apple and Tesla, we don't anticipate, I think Tesla also suffered from some coloring in the data, but I think we did not see any Apple trades having this extreme spread trades. So we are going to be making a simple assumption here. We are just going to assume that all trades that have a NASDAQ spread between 1% to 5% to be suffering from this policy. And then what we are going to do is we are going to compare, again, we're going to use this closure as our instrument, right? Before, we are going to look at the markup compared to the close price, right? These trades price minus the close price, and we are going to scale it with the size of the trade. And we are going to compare what's happening between 5:45 and 6 p.m., right? We chose this 15-minute interval so that, this is a time probably not many earnings announcements would be released. And then we'll compare it to 6 p.m. to 6:15. Okay, so in that time, there is no coloring. So any differential should not be due to the order coloring, right? So if you do this analysis, right, so when there was no maybe Robinhood trading activity, that differential between 7:45:18 to the next subsequent 15 minutes was around 300K for 15 minutes. But then that jumped to 1.8 million right after COVID, right? So here we also observe that. So you can say that for 15 minutes, there is a 1.5 extra additional, spreads that are being paid by the retail traders. And then if you compare it to the total dollar volume, right, you don't see much correlation, right? So if you look at this losses of investors, and if you look at the correlation to the dollar volume, the correlation is around 30%. So this tells us that this is not like a market-wide phenomenon that we observed right after 2020, right? So you can argue that maybe other retail brokers are having these type of policies, and that could be contributing to this extension, right? But here we don't see that. So it's not driven by the total volume that we observe, but actually it is very, very correlated to, like, if you just look at the search interest on the Robinhood term, right? So if you just look at Google Trends and, try to look at the correlation between investor losses and the search interest, you see up to, I think, 80% correlation between those two measures. So again, this suffers a bit of endogeneity, but it gives us some economic magnitude estimates, which is a lower bound for sure, right? We are not including these liquid stocks. We're only considering these pretty extreme events. And as a final point, as I mentioned, right, you can have this sequence of, colored trades, right? So there could be a dark trade benchmarked against the last NASDAQ trade. Then it would be printed to the tape. It might affect the next public exchange trade and so on. But this would create extreme volatility, right? Especially after hours. Right? So if you look at this unprecedented time where we observed lots of price volatility, we think that one portion of this extreme volatility is due to this market order coloring policy. Right? So if you look at the GameStop, right, on January 26, again, Robinhood is not open before 6 p.m. and you see extreme price movements before 6 p.m. But right after Robinhood is not open to trades, all of these price movements get pretty minimal. Right? So that was essentially the trade diagram that I showed for the buy orders, right? So as you can see, there's lots of high spread trades happening right before 6 p.m. and they do get diminished right after the 6 p.m. cutoff. And you can also see that for the sell orders, right? Same idea. For the sell orders, there's a big extreme spread trades happening right before 6 p.m., but they tend to get very, very small amount right after 6 p.m. And then we do formalize this, right? So what we do is that, let me try define a new term, right, for after hours. Right before Robinhood is closed, I'm going to look at the maximum transaction price observed, and I will compute the minimum transaction price. So it's like a simple estimate of volatility, right? Scaled it by the close price for that day. And I'm going to look at what percentage is this, right? So I'm going to create a binary variable. This n% would be corresponding to 3%, 6%, or 10%. So I'm going to check whether you observe more jumps right before 6 p.m. compared to the case where Robinhood is closed after 6 p.m. And that's what we see, right? So this is using all stock universe, right? So you can see with the number of observations. And we observe that right before 6 p.m., there are much more jumps happening while Robinhood is open for business. And then, you can argue that this is actually, working against us, right? So remember, there was a big decay after 6 p.m. in the number of trading. So you can argue that after 6 p.m. is actually more illiquid. So there would be more bid-ask bounce happening. So in theory, you would see more jump behavior happening after 6 p.m., right? So that's even working against us, but we have this additional finding regarding the jump events. So this tells us that there is 4% increase in all trading activity that has 3% jump behavior for that stock, right? So these are economically significant event as well. Okay, so let me conclude by some discussion at the end. So looks like there are some other brokers who are also following the footsteps of Robinhood, but for some reason they chose a different coloring policy, right? So you can see that maybe 5% was indeed too bad for the retail investors, right? So dry belt, again, they're pretty active in fractional trading, and they're using 2.5% for their coloring policy instead of 5%. And here, they're again making some revenue from their fractional trading, so they would be probably happy to interact with that type of retail order flow. And then finally, in the couple months ago, we have seen this statement on Robinhood webpage. They stated that they are phasing out market order coloring. I got so happy. I saw that the impact of my paper, maybe they read this and they thought that this is bad for the retail traders. So, you can feel proud that your paper did a good thing for the overall markets, right? But turns out that they just changed the terminology. So they just now call this, a limit order. But again, the limit order price would be preset by Robinhood using 5% spreads above the last transaction price. So far, there is nothing being changed on this policy. So we still have the same type of order coloring. So, and maybe let me also mention this extended hours disclosure, right? So as I mentioned before, at least FINRA is aware about this discrepancy regarding the order protection rule, right? During market trading hours, we have order protection rule, but after hours, we don't have it. So in all retail brokers, extended hours disclosure, you have this statement, right? The price that you are getting could be inferior to other extended hours trading system. So let me just conclude, right? So according to our identification strategies, right? These two around closure of Robinhood and extension of the after hours, we observe that the coloring causes extreme spread trades. And with this kind of simple back of the envelope calculation, we observe that they are actually indeed significant economically. And then we observe much higher jump volatility while Robinhood is open. And this is only applicable for after hours, right? We did not check this for intraday. So this is future work for us. And then, I think as in one of the comments stated, there are lots of room for policy here, right? So one could be, why are we disincentivizing, retail traders from limit orders, right? So I think that should be one consideration, right? That should solve this problem, pretty easily. The second one is, I think, order protection rule. Why is that active after hours, right? So that's another food for thought. And then, I think with this policy, right, given the payment for order flow dynamics, you can actually increase the value of your order flow, right, by creating these retail traders who are not very sophisticated and they just swipe up and they're paying high spreads. And I think here the trust is also very important, right? So I think if we lose the trust of these retail traders, there could be consequences for future stock market participation, right? So if you lose, if you have $100 with one trade, your wealth goes down by 5%. I am sure that investor will not be very happy to continue in this participation, right? So they will probably close their account and they will be they're not going to be participating in this efficient resource allocation process. So for future work, we are going to be thinking more maybe intraday, thinking about Robinhood outages as in the Eaton et al. Paper. And then hopefully, if Words can extend their sample order book, we want to extend our analysis because there would be, we want to stay not just 5% double, right? As Andrew pointed out, we want to show that there's negative skew, essentially, right? For these sell orders. It can be anywhere, but compared to the buy orders, we want to establish that sell orders have negative skew by controlling the overall market variables as well. So currently we only have 2 days, so that's not a possibility. Yeah. Thanks a lot for all the questions and comments. Happy to stay.
Thanks a lot, Mehmet and Preston, for a very interesting presentation. So Mehmet will be here to take questions as long as there are any, he promised. And so before, we have a couple of questions lined up already, but maybe some people have to leave. So let me announce that in 2 weeks, we have Carol Comerton-Ford coming to present. So welcome back then. That's on November 28th. I think first in line for questions is Sean O'Donnell.
Yeah. One remark I had about the identification of Robinhood you might consider is that they receive payment for order flow slightly differently than any other broker. It's a percentage of the spread rather than per share. So when you think about whether Robinhood's trading or not trading, you might consider how the posted spread might be affected.
Yep, thanks a lot.
Can I ask the question?
Yeah, sorry, I'll just make a correction. Carol is in 4 weeks. So it's Marcus Bach-Hansen who is in 2 weeks. Sorry about that.
Yeah.
2 great seminars to look forward to. But you can go ahead with your question now, Young Bin.
Yeah, I have a question about the different diff designs. Maybe the 5% rule is actually try to deter from this limit up, limit down rules, right? So we know the tier 1 security actually have this 5%, like the single stock circulated bricks. Maybe you can have a triple differences analysis actually that focusing on the tier 1 security versus tier 2 securities. For the tier 1, they have this 5% rules, but for the tier 2, that is not SP 500, Russell 1000 stocks, they have this 10% limits. So in the after hours, you would expect those tier 2 stocks that actually have more extreme movements. So this is kind of triple differences actually sharpen the identification strategies. So right now, you're just focusing on after hour before around that 5% threshold, but if you're looking for the tier 1 versus tier 2, maybe that actually help to sharpen the differences. Thanks.
Yeah, great suggestion. Thank you.
Yeah, thanks for the interesting talk. I was just wondering, you mentioned at the end that Robinhood announced that they were getting rid of this collaring. You got really excited, and ultimately they didn't do that. But I was wondering if you could say a little bit more about what exactly it was that you were hoping for. Is the idea that instead of turning market orders into limitable market orders with this 5% collar, market orders would just be passed on as market orders? Because it's not clear that would lead to better outcomes, right? In some sense, that then there's no limit to how a market maker could take advantage of these naive.
Yeah, I think exactly. So after hours, I think there is no benefit to the retail traders to have any kind of spread, right? So we were hoping that this, coloring process would be, would not be applicable. There would be no market order option after hours, right? So you should just be
get rid
using
of the market order.
Yeah,
I see.
Yeah, and one of the things we're looking at is why forcing them into this collar price.
Can you repeat? We missed.
Oh, sorry. We were also thinking, why wouldn't Robinhood just let the trader specify their own limit price instead of forcing them into this specified collar at 5%?
Makes sense. Thanks.
Have you guys considered linking these results to other things that we know about Robinhood, like the top 10 gainers and losers that they're usually getting into, these Robinhood traders, I mean, or maybe even linking it to the Robin track data from 2020, just to tie it a little bit closer to the actual Robinhood brokerage?
No, that's always in our bucket list, but we have not done it.
So I have another question about the cross section of stocks. I'm not familiar with how illiquid the after hours market is. So are all these the trades that you see coming from the small cap segment or even micro cap segment, or do they occur in mid cap and large cap as well?
Yeah, as I mentioned, Tesla, right, was part of, you could see
I
very
missed that.
large market cap stocks as well being penalized by this rule as well. So of course, there is some retail retail intensity issue, right? So if a stock is preferred by retail clientele, we observe much more extreme spread trades on that stock. So it's mostly driven by the retail preference. But yeah.
Are there any other remaining questions? No? Okay. Well, thanks again, Mehmet and Preston. Really interesting. And see you all in 2 weeks.
Yeah, thank you very much.